Nothing in this show should be taken as financial advice. I have no finance background. This is just my outlook and opinion. The Lighthouse report is sponsored by Hedera Hashgraph, so I have a bias towards Hedera.
What we've been seeing is this migration of capital from the public markets over to the private markets. And we've seen the private credit market, which Apollo is a really big player in, really grow. What has happened this year, though, is that given that new bond sales and new M&A deals have been extremely suppressed, the private credit funds are having to get more creative in how they're going to deploy some of that capital, and this is one of those examples.
Why? But why? What are they actually seeing here in terms of value? Do you know?
This is TLT. It's an ETF of bonds, and you could see it drastically drop. Now, we're getting a bounce right now, so you see this little bounce here. So what happens is bonds sell off, and when bonds sell off, yields rise.
Yes, I do think that they believe that once the market begins to correct itself a little bit, and once we move into next year and rates start to even out, that a lot of the debt that they're looking to snap up off of banks' balance sheets will recover to a level that will be an attractive buy for them.
In the Bloomberg News story about this fund, Apollo apparently sees opportunities to refi next year some of the $100 billion of debt that's maturing in 2024. Interest rates have been rising, so how would they refi? I mean, they're going to be paying up more.
So what's going to happen essentially is that some companies are going to need to refinance next year, whether they like it or not, because they're kind of behind the curve and sort of getting ahead of their maturity. So what Apollo is now seeing is an opportunity to snap up some of those bonds because they're going to probably come in at a double-digit coupon, like we saw with Carnival recently, just priced at a 12% yield.
This is Coinbase's bonds. So in 2028, they're offering 3%, 3.375%. So in 2028, if you held onto this bond, they'd pay you 3%. But what happened is prior to 2028, you're seeing a drastic decline in price. So now the yield is over 15%. And when I wrote the article, it was around 17%, right? So right here, 15.4%. And what happens is when bonds and yields have inverse relationships, so if the bond sells off, the yield goes up higher, right? And what's happening right now is Apollo Global is trying to issue bonds for mergers and acquisitions. So Twitter, Brightspace, Tenneco, these are massive companies that can't even issue bonds because there's no buyers. There's nobody that's willing to take on the risk. So that risk is on the balance sheet of Bank of America and Citigroup and all these other banking big banks. And what we're going to see is they're holding on to these bonds until the liquidity comes back into the bond market.
Anticipate that we'll see other big players in this space other than Apollo get into this or expand into this?
Yes, I do. I think it's a lucrative opportunity. The private credit funds are sitting on a lot of dry powder. They have to find a way to put this money to work. And although investors were not interested in the $43 billion that's currently hung on bank balance sheets, that has a lot to do with the state of the economy that we're in right now. And with these private credit funds, what they're often doing is a buy and hold strategy. So they're holding this debt until it matures, which can allow them to make some attractive returns.
Genesis is one of the oldest, largest crypto lending platforms, and a lot of exchanges use Genesis in order to use their lending platform. So Gemini is an example of this. When you use Gemini Earn, you're really just using Genesis, and Genesis is in the back end of all of this. So they're primarily focused to larger institutions, VC whales. The whales don't use Celsius, they go through Genesis, and as FTX collapsed, Genesis started to have a run. So everybody started withdrawing their money from Genesis, and now Genesis is in trouble and they need money. The other thing that happened was Three Arrows Capital, Babel Finance, they both went bankrupt and they owed Genesis money. So then what happened was Digital Currency Group stepped in and gave a $1.5 billion loan. Well, it turns out that wasn't enough, and now Genesis needs another $1 billion loan. Genesis is massive, and their parent company is Digital Currency Group, and it's spread out to over 165 companies, including Coinbase and Ripple and Ledger. And what's going to happen is somebody has to make good on these loans. If they completely go bankrupt, this digital currency group is tied everywhere. It's tied to the GBTC, so Bitcoin that's on the New York Stock Exchange is held in a trust that's under Grayscale, but that's a sister company of Digital Currency Group. So all the assets that Digital Currency Group has is in threat. They may have to sell some of their assets that include equities and tokens. So the crypto market is already soft. The traditional market's not going to give them a loan, even with them holding massive amounts of wealth and crypto tokens. The banks are going to see that as way too risky. They can't even raise capital for Fortune 500 companies, so it's very unlikely that Digital Currency Group is able to raise capital. So they may have to sell some of their equity as well as some of their tokens. And like I said, it's already a soft market, so that's the scary part of all this. If they actually have to do that, that's going to be a lot of sell pressure into the markets, which translates to lower prices. Genesis. This is Max Boonin. He works for B2C2 Group. And in this tweet, he offers to extend an offer to purchase the loans from Genesis Trading in order to alleviate the current liquidity shortfall. So B2C2 Group may absorb Genesis's liquidity issues, and they're going to, instead of Genesis going through a bank, they set up a private deal where B2C2 Group may collect some money, or they have some type of assets or anything like that. He's in the industry, and he talks about a couple of different theories on why Genesis collapsed to begin with. He said 3 Arrows Capital bought GBTC, so that's Bitcoin on the New York Stock Exchange, and it was selling well below the price of regular Bitcoin, so it's like 30% cheaper. And he speculates that 3 Arrows Capital bought the GBTC, and they locked it up, and then they levered it up in order to collect that arbitrage. So when GBTC gets back to fair value at Bitcoin's price, they would make a pretty hefty amount. So they kept levering it up, and GBTC did not move up. And that's part of the reason why a lot of the lending platforms failed, is because they were taking GBTC as collateral like it was Bitcoin. And then Bitcoin's price depegged from the equity GBTC. What's interesting about this B2C2 group is that it was founded by SBI. So SBI, as you know, is the RippleNet partner. And, SBI Ripple is a pretty large Japanese institution that partnered with Ripple early on. They made this crypto hedge fund, and now they're looking to buy Genesis's assets. And Genesis is the largest lending platform in crypto. It's the largest CeFi lending platform in crypto. So very interesting to see how this all rolls out. Genesis is not going to be able to get a loan from the traditional banking system, nor will Digital Currency Group. So if they're able to get a loan through B2C2, that might be the silver lining with all of this.
Move. They're on a buyer strike from bonds. I mean, we're starting to get some new institutional accounts showing up, but we hadn't seen an interest in an institutional bond account for the entire first 9 months, or 8 months anyway, of 2022. And it's just nonstop outflows, and there's nobody to buy. As you point out, QT doesn't help, even though there hasn't been that much of it. It could get much worse. Banks aren't allowed, through regulatory controls that have been greatly restricted from 20 years ago, to act as the shock absorber. So where's the buyer? It's one of these things where it's so cheap relative to stocks, and so much wildly more attractive than the bond market was, particularly this mix that I'm talking about, but just the treasury market itself. That the reason it's so attractive is because nobody will buy it.
Jeffrey Gundlach is known to be one of the largest bond investors, and his net worth is $2.2 billion. He's a very successful bond investor and businessman. So He's saying that the bond market right now is offering really attractive returns, and he's building a position in bonds now. So he's willing to take on the risk that this is kind of like the bottom of bonds, and he's starting to put money into the bond market.
I take I metaphorically think of Fed rate hikes as shots of Crown Royal. And that's Canadian whiskey, of course, Crown Royal. But the reason I use Crown Royal is there were NFL ads where there was the setting was a bar, and people are in there watching the football game, and they're all drinking, and a referee comes in the full attire, blows a whistle, and he says, "Everybody, your next drink is a water," and the tagline is "Stay in the game." Well, the Fed did one shot of Crown Royal back in March, two shots in April, three shots in each of the next three meetings. They're going to do another triple shot, or it looks like. And I mean, have a water. I mean, slow down. I think what they're doing here, I really agree. This is a strange words to be coming out of my mouth. I agree with Larry Summers that the Fed is really being kind of reckless here. And don't forget the elephant in the room that doesn't get enough coverage. They think they're going to do quantitative tightening. So they're doing a shot with a beer. And I just think that the chance of them making it to the third quarter with this sort of a drinking regime, and i.e. Fed tightening regime, is really a pretty big
This is
mistake.
a federal funds rate, and as you see, these slopes are very gradual. Every one of these is gradual. Every time they raise interest rates, it's pretty gradual. If we zoom in today, let's see how it looks. It looks straight up. And what's happening is they're doing 5%, 75 basis points, very high rate hikes, and they're working off of old data. CPI data is old. They don't have real-time data, and this is causing aggressive monetary policy combined with illiquid bond markets and everything else that's going on. So as they're raising interest rates, they're putting more stress on the system. Eventually this breaks.
That we're going to see negative inflation prints, maybe not deeply negative, but I'm almost certain we'll see some year-over-year negative inflation if the Fed really is going to go down this path. My point of view is inflation may go to 2% next year. I don't think it will, but I'm totally open to that idea. But if you're going to be open to that idea, you need to attach the other thought that it's not going to stop at 2. If you have that kind of momentum, it is going to go negative. And just imagine what the Treasury market would do if we went negative on the inflation rate. I mean, it's very obvious that you would not be hanging out above 4% on the 2-year and near 4% on the long end as well.
So CPI data, when it comes out, it's a bit lagged. And also the inflation might not all be for monetary policy. You probably have energy prices as well as physical policy. So the COVID stimulus checks and the supply chain stress, all of that factors into the reason why prices are higher. So you could see, during some of these recessions, 99, you had these drops. 2008, you had the sudden decline, right? And that's what Gunlock is saying, is that when we get to here, when this starts dropping, it's going to have momentum and really drop down hard. And then the Fed's going to react like they always do and bring it back down to 0% interest rates and quantitative easing.
It's really fascinating that with all of the volatility in bonds and equities this year, there's been so little volatility, particularly over the last 6 months, in gold and Bitcoin. I mean, gold just sits there at 1,700. It seems like it's doing well when it's at 1,800, and it's doing badly when it's at 1,650. And Bitcoin, Bitcoin actually is starting to look like a real currency in terms of it's not changing 20% in an hour anymore. It's not even changing 20% in a week. It's not even changing 20% in a month. It's at 20,000 plus or minus 10% all the time. I think Bitcoin, more than anything else, is you only want Bitcoin, in my mind, if you think the government's going to give money away again. And unfortunately, ultimately, they're going to, I think. I think to fight off the consequences of what they're doing and how much debt we have, I think in the next recession, there's going to be so much pain that they're going to do a money giveaway again. And unfortunately, that might be the one that is the last straw for the dollar, because every time they do a money giveaway or a quantitative tight easing program, and they'll probably do both again, they do it an order of magnitude greater than the last time.
Yep.
So everyone thought it was wild, did a couple of trillion of QE back in the 00s, and this time they did 4.5 trillion. Everyone thought it was kind of amazing that they gave, several $100s away, and then it was a few $1,000s away. Next time it's going to be tens of thousands of dollars, because they have a fundamentally broken system of consumer debt-based spending and government debt-based entitlement programs, and there doesn't seem to be any catalyst other than economic shock to really alter the course. And unfortunately, the economic shock will alter the course back to where we were 2 years ago.
The Fed's going to over-tighten and the whole economy is going to crash. Then they're going back to printing money, 0% interest rates, and QE. The recession will be so bad that they issue more stimulus checks and they'll be overextended, and that money will boost the price of Bitcoin as well as other inflation hedges.